Welcome to the Skilled MBA Finance Case Study Series, where we explore real-world ventures that embody financial innovation, strategic thinking, and long-term value creation. Luster LightTech, a rising star in the optical technologies sector, found itself at a pivotal juncture during its pre-initial public offering negotiations. As investor interest surged, the company faced a delicate balancing act, maximizing valuation while building strategic partnerships critical for long-term growth. The leadership team had to make tough calls. Should they accept a higher valuation from financial investors or prioritize strategic partners who offered more than capital, such as access to markets, technology synergies, and operational guidance? This case examines how Luster LightTech structured its financing strategy with discipline, choosing partners who aligned with its mission and growth trajectory. It explores how the company safeguarded its strategic autonomy, ensured sustainable capital access, and prepared for life as a public entity in a competitive and fast-moving market. Luster's story highlights that in high-stakes funding rounds, financial prudence must go hand in hand with strategic alignment. The right capital partners can be the difference between fleeting momentum and durable value creation. Luster LightTech Co. Ltd., a leader in machine vision solutions, plays a pivotal role in quality control for advanced manufacturing. By mid-2020, Luster's net profit surpassed its entire 2019 earnings, highlighting its growth potential. This success is driven by robust research and development, increasing market demand, and cutting-edge technological expertise. Luster was gearing up for its initial public offering, a pivotal step in its growth. Investor confidence was crucial, as market perception would heavily influence initial public offering success. However, a new pre-initial public offering funding round brought unexpected challenges, especially from a key strategic investor. Managing this investment round was essential to sustain momentum and maintain market confidence. Foxconn Technology Company Limited, a global electronics giant, proposed a dual value proposition to Luster. They offered not only capital investment, but also potential orders worth 100 million yen annually. However, Foxconn's valuation of Luster was significantly lower than financial investors, arguing that their business contribution justified the discount. Yeo faces a critical decision: accept Foxconn's lower valuation to secure a strategic investor and access substantial customer orders, risking a perceived weakness in initial public offering markets, or reject the offer to maintain valuation integrity, risking the loss of a lead investor and delaying pre-initial public offering funding. Strategic investors offer business synergies, market access, and industry credibility, enhancing customer validation and supply chain integration. However, they may demand lower valuations, create business dependence, and introduce competing interests, complicating negotiations. Balancing these factors is essential to navigate pre-initial public offering strategic investments effectively. Chairman Yeo led an executive meeting to craft a negotiation strategy focused on maintaining high valuation. The strategy aims to preserve market positioning, highlight financial strength through research and development success and earnings growth, and address initial public offering timing to sustain momentum and positive investor perceptions. The primary goal is to persuade Foxconn to accept Luster's original pricing, ensuring the strategic partnership remains intact. A secondary objective involves structuring a deal that leverages Foxconn's customer relationships while maintaining equity value. If negotiations falter, alternative funding sources, including other strategic partners, will be explored. A long-term vision focuses on creating a framework for future partnerships that align capital needs with valuation goals. By mid-2020, Luster surpassed its full-year 2019 earnings, demonstrating robust profit growth and revenue acceleration. This financial performance underpins Luster's higher valuation expectations, crucial for negotiating favorable terms with strategic investors like Foxconn. Understanding these financial dynamics is essential for aligning short-term capital needs with long-term valuation goals in emerging markets. Strategic negotiation involves leveraging strengths to negotiate with powerful investors. Pre-initial public offering pricing decisions are crucial as they influence market perception and initial public offering success. Balancing immediate capital needs with long-term valuation is essential. In emerging markets, strategic investor relationships play a pivotal role in navigating complex business environments. Luster must weigh Foxconn's strategic value against accepting a lower valuation. Key factors include long-term growth potential and market positioning. Effective negotiation requires leveraging unique strengths, even against dominant investors. Momentum and signaling are crucial in initial public offering fundraising. The Foxconn negotiation outcome could significantly influence market perception and investor confidence. Luster could explore a hybrid deal structure, combining equity investment at full valuation with prepayment for future products. Conditional valuation tied to order volumes might also be viable. Alternatively, separate investment and supplier agreements or seeking other strategic investors could preserve valuation while securing strategic benefits. Luster's strategic position in the machine vision market is bolstered by a 20% plus annual growth rate in industrial automation and government backing via the Made in China 2025 initiative. Rising quality control demands in electronics and the shift towards smart factories enhance Luster's role as a technology leader with substantial growth potential across sectors like electronics, automotive, and pharmaceuticals. In fast-growth tech sectors, selecting investors transcends capital acquisition, impacting future positioning and market perception. Maintaining valuation integrity in pre-initial public offering rounds signals confidence and growth potential. Effective negotiation requires understanding mutual interests. Foxconn's need for innovation matched Luster's strategic partnership goals. This case highlights the importance of balancing immediate capital needs with long-term market strategies. Thank you for exploring the Luster LightTech case study. For more expert-level insights into real business challenges, subscribe to the Skilled Master of Business Administration case study series. Join us next for a deep dive into sustainable supply chain management in the global fashion industry. Mobile +91-87553-00795. Email support@skilledmba.com. Website https://skilledmba.com.